Vijay Valecha is here. He's Chief Investment Officer of Middle East Markets at Century Financial, live for us in Dubai. Vijay, welcome to the program. Great to have you on today. Of course, we're going to unpack what's been happening in the Middle East equity markets, but I wanted to start at a more global level if we can, and in particular, what has just unfolded in the UK. Let's pull up what we're seeing right now with UK gilts, because we saw British bond markets tumbling after Chancellor Rachel Reeves' quite emotional parliamentary appearance at the overnight, and of course, the government's welfare U-turn as well in focus here for gilt traders. This is going to be key to watch today as the session gets underway in Europe. How serious do you think is the market's loss of confidence here? And at a more broader level, are we facing a repeat of the Truss-era bond crisis?
Absolutely. We are facing a big trouble, not just with the UK gilts, but world over. Along with the UK gilts falling yesterday in prices, we also saw the Euro Buxel fall. We saw German bonds also fall. The Bund as well fell. We saw the US Treasury bonds, 30 years yield especially, the T-bond Ultra falling by more than 1.5%. So a global decline in bond prices is coming in. The yields going higher for all countries. Most of the countries can't really afford to keep up these payments. And with these payments, the deficits keep going higher and higher. If the interest rates keep getting higher because the yields are not falling for the longer duration, it could definitely lead to a bigger problem in the future.
Okay, so of course we're watching this really closely. The UK's fiscal credibility is on the line. Beyond bonds, how do you see this political turmoil playing out in sterling and UK equities at the open today?
Well, we see that the turmoil will be subdued to it today for sure, because we had a very, very massive day yesterday. But however, we are not out of the woods yet. So we are definitely in trouble, and we will see a sell-off coming in definitely from the UK side. Will it be a contagion effect for the rest of the markets is yet to be seen. So far, the political turmoil is only based on a certain region and not globally. However, what that can do, like you said about the gilts, a bond price fall in a massive manner could actually trigger equity sell-off as well. So yes, the markets are quite closely linked with each other. We have to understand that. A bond market crisis does mean a worldwide crisis. So that is something which has to be avoided. So the political turmoil is important to see, but not today, but definitely for the next coming weeks.
Vijay, the other thing I'm looking at right now is, of course, in the United States, this drop in US private payrolls, the biggest drop in over 2 years, certainly coming as a shock for traders as well. Do you think this could potentially force the Fed to reevaluate the timing or scale of potential rate cuts? It was interesting to also hear the Fed chair, Jay Powell, weighing in Sintra, saying he would have cut rates already by now if it had not have been for the Trump administration's tariff agenda.
Absolutely. From the Fed's point of view, there are multiple things that they have to look at. They have to look at the inflation numbers. We have decently subdued inflation numbers. It's hovering around the same area. We are not really seeing a spike above the 3%. So that's not really a problem. Unemployment numbers are going good, so that's not really a problem. Although, however, the biggest reason that the Fed would eventually cut rates could be unemployment. The tariffs are definitely what is playing on the mind of the Fed right now. July 9th being the date where we'll actually get some results, or at least most results, will definitely make an easy stance for the Fed if they really want to cut rates. If what we had in Vietnam, a 20% tariff, is a similar deal that the rest of the world gets, then we do expect that interest rates will come down. There might be 3 or even 4 rate cuts this year. However, if that doesn't happen, if the tariff war with China looms for a much longer time, interest rates have to be kept at this rate, and the inflation fears will always resurface back.
Interesting to watch. And Vijay, as we see the Saudi and UAE PMIs coming through for the month of June, let's shift our focus over to what's happening here in the Middle East, because of course we've seen huge volatility in global equities, but not so much in regional equities. The DFM still trading at around a 17-year high, despite the Israel-Iran conflict, and still with a YTD gain of around 10%. So what's your current thinking around the Dubai equity market right now, and is it ripe for some kind of pullback after what we've seen unfold over the last couple of weeks?
Well, I think we have seen a stellar run up in the DFM. DFM is up almost 40% in the last 52 weeks. It's up 10% plus year to date. We are seeing a 17-year high, 6,100 being the 2008 or 2008 January high is the next barrier that the DFM has to be breaking out of. However, I do not see the potential problems globally to impact DFM and ADX as much. DFM is still trading at very, very low valuations. A 9.3 price to earnings is what DFM is trading at. It's extremely low as compared to global standards and even regional standards. So DFM is quite insulated from a market fall. However, if the global markets are going to be in a bull run, we'll see a huge impact, and the biggest earner, the biggest alpha will be probably DFM.
What about what's happening on the ADX as well? On the cusp of this 10,000 level, what is it going to take to break that and sustain it materially moving forward? And again, are equity markets in the UAE looking a little rich right now?
Yes, absolutely. The 10,000 mark on the ADX has been quite some concern, not just today, but for the last 3 odd years. We have been coming close to that mark, not being able to break it and sustain about it. So that is something to be seen, but it does look like the consolidation has been for 3 years on ADX. Not as low valuations on the ADX. It's trading at 15 times earnings. At the same time, ADX is much more stable as an index because it's much more diversified. So that definitely brings an advantage for ADX. We definitely think that a breakout above 10,000 will be the next cycle of the bull run. Another 10 to 15% move can come in once the 10,000 level is properly broken.
One of the other interesting things we're watching globally right now is the fact that the US dollar continues to stay in the doldrums here as well. When you look at the translation for the UAE and for Saudi Arabia, because of the currency peg, this should really help tourism. It should also help exports as well. Do you think local equity markets are reflecting that reality?
The local equity markets are banking on the fact that the US dollar is falling, and the prediction that the US dollar might get weaker in the next 6 to 8 months more so. Even if the interest rates do not come down by more than 2 or 3 basis cuts, let's say, that we'll get from the Fed this year, we still expect the dollar to actually weaken a little further. And that weakening will help not the entire region, but yes, definitely UAE and Saudi will be the biggest gainers from it. Dubai, the first gainer, because the tourism infrastructure is very much in place, and any kind of dollar depreciation adds a huge boost to the tourism, also adds a huge boost to the real estate. So we have to understand that real estate buyers from outside are mainly countries from emerging markets. For them, the dollar makes a huge difference. A lower dollar really impacts their buying price of the real estate. So any fall in the dollar will be a very good positive for UAE and Saudi, not so much for the rest of the GCC countries.
Indeed. And of course, what we've seen is the UAE and Saudi accounting for the majority of GCC foreign capital inflows in recent years as well. That's going to be particularly interesting to watch in the aftermath of this 12-day conflict between Israel and Iran, because it's also been suggested to me that perhaps sentiment has taken a hit as a result, and we might actually see some of those capital flows slowing down. What are your thoughts on that?
We did see a little bit of panic coming in 2 weeks back. Besides that, the inflows in the UAE and Saudi have just slowed down by probably a month. I do not see an actual slowdown coming in the inflows of Saudi and UAE. UAE and Saudi have accounted for more than 75% of the inflows coming inside of in the region. And that should, I think, sustain. And more importantly, that inflows should be coming in much faster. I think last year was the first year that we saw higher inflows and outflows from the region, and that should continue for the next 4 or 5 years also. So yes, a slowdown for a month or two maximum, but overall I think the region is safe, and it does look like the investors will definitely feel that this is a good, safe region to be in. And we have to understand that if interest rates do drop, DFM and ADX are very high dividend yielding stocks indices as well. So we will see inflows coming in, not just in the index, but also in the broader economy.
Vijay, how concerned are you about the impact of US tariffs and current trade flows and the fact that there hasn't been much progress, if any at all, on getting this issue resolved between the Gulf leaders and the United States?
I guess we are a few lucky people who are in the region where the tariffs won't be impacting as much as the rest of the world. We saw Vietnam getting a 20% tariff and 40% on the exports that are coming into Vietnam. A similar tariff rate could be expected for the UAE and for the Saudi. The major concern, obviously, again, being that if goods are being shipped into the UAE and being repackaged and being sold out. So transshipment might have a 40-45% tariff. But besides transshipment, I don't think business will be impacted by the tariffs in this part of the world. What will be impactful is that we will see that if China tariffs don't work well and if the dollar gets higher for that, that becomes a problem for the region. But the direct tariffs with the US, not that big a problem. We will see definitely a trade deal happening between the UAE and India, possibly also with Japan, and those will actually move the markets a little more than the US trade deal so far.
Let's shift focus quickly to the energy space as well. We've just seen Saudi Arabia signing $27 billion worth of clean energy and petrochemical deals with Indonesia. How transformative do you think that partnership could be for both economies, and who receives the most benefit as a result?
I think Saudi Arabia is definitely the person to gain the most from this. Saudi Arabia is well placed in their non-oil economy in expansion. They're doing a really, really good job at it. Alternative energy is just a part of that program. Overall, the entire development around the non-oil sector is growing in the Saudi at a very, very fast pace. Saudi is poised to be pretty much a 50% non-oil country by 2040, and by the looks of it, they're going at a much faster pace than that as well. So we do expect that Saudi will be the biggest gainer from this deal. There will be potential gains from other countries, but Saudi Arabia is well poised to gain the maximum from it.
Indeed, key to watch with the Saudi economic outlook hanging in the balance as we see oil prices continuing to potentially move lower in the second half of the year, and as OPEC prepares to meet on Sunday. Vijay, we'll save that for the next conversation. Thanks so much for being here today. That's Vijay Valecha there of Century Financial Live with us with the latest on the market.